Okay, hello everybody. I'm going to get started. My name is Philip Palumbo, and I'm CEO and founder of Palumbo Wealth Management. I'm super excited to present to you today how not to run out of money. So I've been doing this for close to 21 years, and I exclusively work with my clients and making sure that they maintain their lifestyle, as well as make sure that they don't run out of money. So I'm going to speak for about 30 minutes, 35 minutes, leave 5 to 10 minutes available for Q&A. So in the chat box, you can indicate any questions you have there, and I'll do the best I can to get to as many questions as I possibly can. Okay, so let's get right into it. The first thing as it relates to what we're going to talk about is to help you understand the concept of unlocking a work optional lifestyle. I'm writing a book about this on chapter 8.5 right now, close to chapter 9 of 12 or 13. And the most important message that I want to convey is rather than people say to themselves, I want to retire at 62, 66 years old, when I get Social Security, and they have this arbitrary number because they heard their neighbor talk about it, their family friend talk about it, etc. I never liked that mindset. So as a firm, I retired the word retirement, and I'm using work optional as we think about things going forward. The great thing about work optional, it's a mindset that you ask yourself, at what point in my life will I be able to either stop working completely, maybe work 2 to 3 days a week, get away from the grind, or maybe you work because you enjoy what you do. But what you're going to discover is at what point in your life will you have amassed enough money that will generate enough income so you can continue to maintain the lifestyle that you're used to. And that may be at 50, maybe at 52, maybe at 55, maybe at 58, maybe at 65, right? But the most important thing is understand is how quickly can you get there, number one, because it gives you a great sense of peace of mind, which is really important as we go through life. And number two, when you get there, you can decide what it is exactly that you want to do. So what we're going to talk about today is a lot about that. And when you get there, how to make sure you don't run out of money and continue to maintain the lifestyle that you need to. So what's the exact process that you need to be thinking about? The first step is, as I talk to people about, is you need to sit back and relax and ask yourself, what is the vision for your life for the rest of your life? A prospective client, I never forget, comes in my office and was like Kramer coming in from the Seinfeld episode where he was completely rambunctious. He was like a bull in a china closet where he sat down and he was so anxious. He was 67 years old, pharmaceutical sales rep. And all he did was come in and tell me how much assets he has, how much income he needs, and can he retire? And he's going 1,000,000 miles per hour. And I literally said to him, that's all I said to him, relax, sit back. And I'm in my conference room right now, which we were in, and we have a nice view outside here. And I said, just sit back and tell me, what is your vision for your life at this point? And how do you see your life for the rest of your life? And as soon as I asked him that question, you can see his complete physicality change. He relaxed. He was much more dynamic in terms of understanding what he wanted to do for the rest of his life. And he started to tell me whatever it was, downsize, buy a house in Florida, golf. He wanted to no longer work in the industry that he wanted to do. He wanted to start a small consulting business. So he went through everything that he wanted to do, and it completely relaxed him, which helped the meeting tremendously. And we went through the process that I'm going to outline with you today. So step one is, what is the vision for your life? What does that look like? What are you going to do day to day for the rest of your life? Once you understand that, then the next question is what is the lifestyle cost for that vision? So what is the cost? What does it cost per month for that vision? Or to keep it even more simple, what is your number, right? So what is your number on a monthly basis that you need to be able to maintain the lifestyle that you are used to? Another example, a prospective client just came in my office last week and he's selling his practice. So he came into my office, and when we sat down together, we painted a picture of a vision for his life. And then he said to me, which he was really anxious about, he said, Phil, he goes, I need $40,000 net after tax per month. Based on everything I just told you, based on my assets, can I achieve that? So we went through this planning exercise, again, which I'll review with you today. And when we went through that planning exercise, I was able to articulate to him and build conviction that he's at a point where he unlocked a work optional lifestyle. You could sense the great peace of mind that he had, which this is what this is all about. And now what he's what his choice is going to be, he's going to sell his practice, but still work in the practice 1, 2, or 3 days a week. So he's going to get away from that daily grind that he was working for about 4 or 5 days. But he knows that as he's going to work every day, that it's his choice, which gives you an incredible sense of peace of mind, flexibility, and freedom. And that's the goal. But we need to know what your number is. So next thing, once we get an idea, so how do we actually figure out what your number is, right? So how do you figure out your lifestyle cost? So in 21 years of doing this, the first thing I always advise my clients is, I want you to go back the last 6 months. I want you to look at your credit card bills. I want you to look at any checks you wrote out of your checking account, cash you withdrew from ATMs, cash that you withdrew from the bank, any type of digital payments that you're using, such as Venmo, PayPal, and look at it the past 6 months. Go back 12 months, even more ideal. And what was the average number? And if you found the average number was 10 or 20 or 30,000, perhaps that's the right number. That's the first step. The second step I want you to think about is, of that number, were there certain transactions that were miscellaneous, right? Maybe a roof went on your home, you had to replace it. That was $40,000, $45,000. Well, you can back that out because most likely you're not going to have another roof issue in the next 6 months, 2 years, 5 years, hopefully 10 years or greater. If you just joined a country club and you had to put a down payment of $12,000, $15,000, and that's going to be annual dues, and that's got to be included. So go through the details of those numbers with a fine-tooth comb to make sure that the average number that you got is accurate. That's step one. When I have clients go through a similar exercise, then what we do is go through a detailed analysis. You don't have to see all these numbers and understand all these numbers, but the key thing that I want to point out to you is when you're putting together an expense report for yourself, what your lifestyle actually cost, obviously you have your obvious things like cable and internet, your mobile phone and your car payment and gas, etc. But here are the big items that I want to make sure you don't forget. Number one is medical. Medical is a big expense that people have to think about, right? So if you're of the age of, if you're under 65 years old and you're at a work optional state where you stop working completely, well, you got to ask yourself is, what are my premiums going to be for medical insurance? What are my options? If your spouse is working, perhaps that's an option. You could go on their plan or the exchange, right? So you got to figure it out, and how much is that going to cost per month, and what does it actually cover? The second thing is dental costs. Dental costs, I find that for a lot of my clients is big. A lot of them want to do cosmetic work that they always wanted to do, but they never got around to it. Now they're going to do it. That could be 10, 12, 50, 75,000, even 85,000. So these numbers can add up. So dental costs in terms of ongoing dental costs. So medical health is a big expense. You have to make sure you're included in that number for yourself on a monthly basis. The second part is gifts. Gifts to children, grandchildren, charities. What does that number look like? Make sure that's factored in your overall expenses. Miscellaneous. Miscellaneous here, I typically use that for if you currently own a home or a second home or a third home, there are maintenance costs of those homes every single year, right? We all own a home. We call an electrician, we call a plumber, they come to our home. Next thing you know, we get a bill for $1,000, $2,000, or maybe the roof goes and there's a $45,000, $50,000, maybe $70,000 bill. So we all have these extra maintenance expenses per year that needs to be factored into our overall when we come to the point where we figure out what our number is. So these are the three key areas that I noticed that a lot of people tend to really not include into their overall number. The other point, then what I want to do is once I get to that point, then what I want to do is I want to understand when I look at their overall expenses, I divide it into what percent, I'm just going to keep this simple, is fixed and what percent is variable, right? Why do I want to know that? I want to know that because in a situation where we go through economic challenges, much like we're going through today, or like we did in March of 2020, where portfolios tend to decline, and if you're living off of part of your income is coming from your portfolio and your portfolio is down, oftentimes I'll call the clients and my clients and I'll say to them, listen, your portfolio is down. Let's reduce your outgoing money expense by $500 or $1,000 per month, right? And when I looked at their expenses, I realized that 50% of their expenses is variable. So this is restaurants, vacations, country club, travel, etc. So I know there's flexibility here versus fixed, right? So fixed is stuff like, food we have to eat, uh, car, paying for our car, gas, oil, electricity for our home, real estate taxes. We have to pay for that, right? So that's fixed. Variable is things I just mentioned. So when I tell a client I need to reduce, I think we should reduce your distributions by $500, 1,000, or 2,000 a month, whatever that number is for that particular client. I know we can do that. It's just a question of, does the client want to do that? And if you ask me what's the typical response from clients, it's 50-50, right? Most of the time clients will say to me, Phil, I appreciate that, but listen, I worked my butt off to get where I am today. I'm continuing my lifestyle. I get what you're saying. I appreciate it, but keep sending me the money. Others will say, I get it, let's reduce it. So understanding fixed and variable, this is where it will help as you're planning and understanding your overall lifestyle cost. So once you go through that exercise, then we got to talk about risks. So if you're spending 10, 20, 30, 40,000 or more, right, per month, we have to understand that there's a very high probability that if you're married, that one spouse may live to 92 years old. There's a 50% chance of that happening. So when it comes to planning, I like to plan going out to age 95. So you have to know that the amount of money or your number that you need to spend on a monthly basis and the amount of assets you have needs to last a long period of time to make sure that you don't run out of money and be a burden on your children if you're married and if you have children. So that's the first risk that you have to make sure that you understand. Some of the quick statistics in terms of if you're a male, you have a 50% chance of living to 86. If you're 65 years old today, if you're a female, there's a 50% chance that you'll live to 88. The other risk is inflation risk. And today, more than ever, we all know that we're 40-year highs in terms of CPI, which is inflation. The biggest question we all have is, what is it going to look like going forward? And I always like to say, nobody knows. I do have an opinion, but in the end, nobody knows. Obviously, you need a crystal ball to figure it out. But what we do know is we can look at some history, understand where your big ticket items are, and how you should plan for that. So for example, healthcare, this goes back from 2017 2019, average increases or the average amount that people are spending out of their total expenses. 14% people are spending on healthcare, 33% of their overall expenses are going towards housing and mortgage and maintenance and things of that nature relating to housing. 13% food and beverage, travel 5%, transportation 11% if you're 75 plus years old. So these are the big ticket items that people are spending money on. So what's the inflation for these particular items? The inflation for healthcare on average since 1982 to 2022 has averaged around 4.7%. Housing has been 2.8%, food and beverage 2.7%, travel 2.2%, not as bad as people thought. Obviously, all these numbers have gone up recently. So we know that if you plan on using an inflation number around 3 to 4%, that means this. That means if you spend $40,000 or $20,000 per month, that in about 15 to 18 years, you're going to have to double that number. So if you're spending 20, that's going to be 40. And then you have to double it again about 15 to 18 years thereafter. Now, if inflation, based on what's going on, averages something greater than that, you may need to double that money in 12 to 15 years. And then again, right? So this is how you have to think about it. So whatever you're spending today, you're going to need more of that as you think about things going forward because of inflation. So once you understand the vision for your life, what your lifestyle costs to accomplish that vision, then we all have to ask ourselves is, where is your income going to come from to pay for this lifestyle, right? What's your income going to come from to pay for this lifestyle, which is essentially your vision? The way I like to look at it is, first, you have your, what I call your fixed income. So I have here earned income. So earned income means a lot of my clients, they're consulting or they're working part-time. That's considered earned income. Real estate rental income, Social Security, and pension. These are the primary sources of fixed incomes that are actually coming in. When you evaluate your fixed income, you have to ask yourself, how reliable is this income going to be when I stop working, and for how long? So Social Security, if you think about it, right? There were used to be 3,000 for each person that was retired. Now it's 2.7 people working for each beneficiary that's retired. That's because the baby boomers that are retiring, and it's a tremendous demographic. So those numbers have shifted. So the question is, with Social Security, will it be here for the rest of your life? That's the question number one. Same thing with a pension. If you're getting a pension from your corporation, which is not as common today, how reliable is that pension? Earned income, if you're working part-time or consulting, how long are you going to be able to do that for? How long do you want to do that for? So you got to really break it down to really understand how long these fixed incomes are going to last. And then you have to then look at your, what I call portfolio assets, which are your taxable assets, and then your retirement assets, which are IRAs, 401ks, 403bs. That's what you've saved up for all through these years, invested to build a certain nest egg that can be used to generate income. So essentially the way it works, for example, if you're spending $200,000 a year, let's say your fixed income is giving you $100,000. So that means you obviously have a deficit of $100,000. This is where you ask yourself, the portfolio assets that I have saved up thus far, is it enough to fill this gap? Is it enough to fill this gap? And this is where, as you go through this unlocking work optional lifestyle, this is what you really want to know and understand. Have the assets you accumulated, including the fixed income, is it enough that I can stop working today, work part-time, or if I love what I do, continue working? So you have to evaluate this and see what this looks like. So once you understand these dynamics here from a portfolio asset standpoint, the next question you have to ask yourself is, how much can you safely withdraw from your portfolio per year without running out of money at some point in your life? So if you retire, if you stop working at the age of 50, you go out the age of 95, 60, same thing. The reason why you want to go out the age of 95, and this is some feedback that I get from a lot of prospective clients, is, Phil, I'm not going to live that long. And that's changed a lot, number one. Number two, what's the dynamics of your family and the history, the health history of your families? That's important to go by. What type of lifestyle do you lead? Do you lead a healthy lifestyle? And if you have longevity in your family, you live a healthy lifestyle, there is a high probability you can live to 95. But here's the most important reason why you need to use 95 years old, is because you want to be conservative in your estimates always, because it gives you a higher probability of achieving that goal, right? So none of us can predict what I just said in terms of how long you're going to live, or where the markets are going, or the economy, or inflation. But we just want to stack the odds in our favor as best as possible. Now, if I plan until 75, that doesn't make any sense, right? So that's why plan to 95 makes sense. So let's talk about withdrawals. So let me give you some history on withdrawals, which is super important. So I went back from 1926 to 2020. We looked at 30-year time horizon. In other words, retire, and you have a 30-year retirement time horizon, and then you died. What's been a safe withdrawal rate based on different portfolios? So a conservative portfolio of 25% stocks, 75% in bonds. If you withdrew 4.88% from your portfolio, you did not run out of money. If you got a little bit more aggressive at 50-50, 5.76 and 6.61. So these numbers look very attractive. So again, like I told you before, I want to be conservative with everything, including withdrawal rates. So if this is telling me on a conservative end 4.88, I'm more interested at 4% or less. Again, to be conservative. So, and the reason why, most importantly, is because when I look at the history of markets and withdrawal rates and being a student of all this stuff, what I recognize is there were periods that if you took out more than 4% from your portfolio, you had a chance of running out of money over a 30-year time horizon, right? So if you withdrew more than 4% over a 30-year period, there were time frames since 1926 that you ran out of money. So this is really important. So I want to make sure that you understand this, right? So what I did here is this black line that you can see, right? Anything in these ziggling lines, these lines that you see, various lines you see here are The 25% stock, 75% bond portfolio is the lower line. The middle line is 50% stock, 50% bonds, and the line that's greater than all is a more aggressive portfolio. What I did here is from 1936 to 1965, in a conservative portfolio, the withdrawal rate that you could have taken and been safe is under 4%. That's during this period of 1936 to 1965. That's because a bond portfolio that was aggressively allocated towards bonds had a difficult time from the performance standpoint. That's why withdrawing something greater than 4% during these time frames, you had an issue. The other types of portfolios, 50 stocks, 50 bonds, 75 stocks, and 25% bonds, they were okay during that particular time frame. The time frame where all the portfolios hurt you if you took out more than 4% was 1961 to 1990. This was a period from 1962 really to like 1982. The market went nowhere. In fact, you lost money if you factored in inflation. Interest rates went skyrocketing, right? So this is why when I look at this type of data going back from 1926, that's why I believe 4% or less is the number to be safe to make sure you don't run out of money. If you look at the history of markets, right, we call something called secular bear market, where there are long periods of time where the market goes nowhere, in fact, loses money. Then there are long periods of time where markets go up and make a lot of money. So just to give you a quick example of that, right? So from 1942 to 1966, that was a secular bull market where the Dow Jones averaged 10.5% per year every single year. That's a secular bull market. Another secular bull market was from 1982 to 2000, which is a tremendous run. The average baby boomer turned around 30 years old in 1982, and all the way up to that period of time, it was just tremendous growth, making a lot of money, getting married, and all this type of stuff. And that average return was 16.8%, one of the strongest bull markets that we've ever seen. Bear market-wise, from actually January 2002 until 2009, the market averaged negative 6.2%. So what is my point? First of all, you cannot control when you officially decide to stop working. I mean, you can control, but you can't control where the markets are going to go going forward, right? You may be in one of these situations here. Here's the most important message. If you are properly balanced in your portfolio, where you don't just own 100% stocks, but you own gold, you own commodities, and you own treasury bonds, during these periods where markets were flat, you actually had a return that was respectable versus a flat or negative return just being in stocks. So the key message here is to be properly balanced, right, amongst different asset classes that perform really well. So for example, during that period of 1970 and 1982 where the market didn't perform well, gold really did well and commodities did well because we had hyperinflation, rates went up, and during that period of time, if you had an allocation to those two asset classes, you actually performed really well. So, you performed well. In fact, the average return of a portfolio of 30% stocks, 55% in treasury bonds, 7.5% gold, 7.5% in commodities, that specific allocation averaged around 6% plus during that particular time frame. So the point is you have to be well balanced when you're actually getting ready to stop working if that's something you're looking to do. The other part to talk about is it's called sequence of returns. So again, you stop working. And unfortunately, we go through a tough time from a market performance standpoint the first 2 to 3 years. In this scenario here, 1973 to 1974 was a major bear market. And if you stopped working here, this is an example where someone has $500,000, you run out of money in about 20 years. If you reverse that and you start with $500,000, you start with good returns, at the end of 20 years, you have just around $1.8 million. So when you stop working is actually important. But again, if you remain balanced within your portfolio, that will help you tremendously. The next question is what accounts should you take distributions from first if you completely stop working? So here, the way I show this is simply if you have a $2 million portfolio that's in taxable, meaning that it's already taxed, it's in an investment account, and you have $2 million that's in an IRA money and you're under 72 years old, and if you need 100,000, should you pull 50 here and 50 here, or should you pull it all from your taxable money? Because the money that's going to come out of your taxable account, if it's 100,000 you need, will be taxed at a much lower rate, if at any, versus the IRA, which everything that comes out of the IRA is taxed at ordinary income. So where you pull the money from when it comes to withdrawals is also going to be important from a taxable standpoint. So managing your taxes or your tax rates throughout when you completely stop working is really going to be important to either running out of money or not running out of money, and or maximizing your wealth over that period of time. And understanding which accounts to pull that from is going to be important. So when you look at overall tax rates, we were at 90% back in the late 40s, and in 1955, really it stopped around 1964. The highest marginal tax rate was in the 90s. And then it declined ever since then. But when you think about today with debts that we have, with the debt that we have as a country and the deficits that we have, where are tax rates going from here? So when you go through in various illustrations of unlocking a work optional lifestyle and planning, you got to make sure you're using the appropriate tax rate, because if you're using a tax rate that's too high, well, that makes a big difference versus, and same thing on vice versa. If you're using a tax rate assumption that's too low, then you can completely be off with your numbers. So understanding tax rates, taxes as it relates to your accounts, your income you're generating, turnover within your portfolio, all is going to make a big difference into successfully making sure you don't run out of money. So let's put it all together. And this is so important, right? When I talk to people, hey, do you have a financial plan? People say, oh, I have it in my head. Really? You have it in your head? When I go through with you right now, it's really difficult to have all this stuff in your head, right? So you can't do this in your head. So what we do is, this is an example what I put together for you is John and Samantha Jones, not a client, fictitious client, has current income of needs income of $215,000 currently. They're 59 and 57. When they officially stop working, they want 215. That's their number net after taxes. And I always put at the age of 85, advanced age, you could decrease the expenses, because as we start to grow older, we don't do as many things as we're doing when we're younger. Travel, restaurants, whatever that may be, and your expenses actually go down. And that's the data points to that. In the tax assumptions, we use Form 1040 for federal tax purposes, and depending on whatever state that you live in, that's the tax rate you should be using for your assumptions as well. That's how much money they need. The income that they have coming in, they're both going to do some consulting, make $50,000 combined each. They have real estate property that's going to generate another $50,000 in income, and they have Social Security numbers, which are around $28,000 each. Samantha has a little bit more than John because Samantha is younger. In terms of their total net worth, so what do we have to work with? What we have to work with is they have joint assets, which are $2 million. Retirement assets, IRAs, both have $1 million each, another $2 million. So we have $4 million in portfolio assets to work with to see if they can unlock this work optional lifestyle. And they have residential property, investment property, that's another $3.5 million. So their total net worth is about $7.5 million. So here's what I want to do for this particular client. I want to put all these numbers together, use financial planning software, and see what the outcome is for this particular client. So here's what I tell people all the time. Anybody could input data into software and then give you some numbers. It's how you interpret the data as a planner that makes all the difference. Because here's my objective when I work with you. Number one is when you come in and I review everything like I'm talking about right now, I want you to leave my office with peace of mind, because you know that we built conviction together that gives you the confidence that you're in a work optional lifestyle mode. And you know that because we really crunched the numbers. We were conservative, we inputted all the data, and we went through different scenarios. And here are the scenarios that I go through. Your current situation. The current situation was exactly what I just reviewed with you. This particular client needed $215,000 per year, which is right here. They have $4 million in assets. They have real estate income coming in, et cetera. Based on that, and if they live to age 95 years old, they have a 99% chance that they will not run out of money. Sometimes clients say, well, Phil, can you run it so it's 100%? Absolutely can. That means I'll drop the income probably by about, in this case, maybe $5,000 a year, and that'll bring that number to 100%. So we could always play around with that. The second thing I want to show the client is, well, what's the most you can actually spend without running out of money? As long as I stay at 82% of grade, I'm in good shape. That's 86% chance you're not going to run out of money. I can increase the 215 to $245,000. Why is that important? Like I said before, you want to stay conservative with your estimates, right? So if the client needs 215, but they could really spend 245, that gives me flexibility, gives the client flexibility, because if they need that roof on the home, or they, for whatever reason, were incorrect on terms of what their number was, we have some flexibility there, which is really terrific. So ideally, I'd love to see that. In this case, we did. In terms of 3% rate of return, this is really important. I always tell people all the time, I don't have a crystal ball. Here's historically how I've done, which is very well in terms of my models that I run for my clients, but I can't guarantee you that going forward. But what I would love to do is I would love to see if we planned on using a rate of return of 3%, are you still in good shape? And when I ran that for this particular client, there was a 90% chance that they will not run out of money if they return 3%. But what I had to do is I had to drop the income. I had to drop the income to $207,000 from 215 in the event that we run into a 3% rate of return analysis. Now we could stay at 215. Sometimes the clients say, well, Phil, let's stay at 207 because just in case going forward we go through a really tough time for whatever reason, I feel more comfortable and more sanguine doing that. And that's what we do. The fourth illustration I run for my clients is inflation. So if inflation averages 4% over the next 20, 30 years, how does that affect your overall game plan? In this case, I had to drop the income from 215 to 210 and keep them at an 85% probability. So inflation's a big deal, right? Because if you're returning on average 6%, but if inflation is 5%, your real return is 1%. Same thing with cash. If cash in your bank right now is earning 0.10, 0.30, you factor in inflation of right now 7, you're probably going to see a print of 9 or 10 tomorrow. And you're talking about negative returns of 9, 10% on your cash if you leave it in there over the next 12 months. So inflation is tremendous as it relates to unlocking a work optional lifestyle. So here's what's important, okay? Here we solve for this client. We understand their vision, lifestyle costs, income sources, net worth, and we put it all together. And this is how we build peace of mind for you and for this particular client. So once we go through that exercise, then the next question is, okay, great, Phil. Well, how are we going to start to take distributions? How does this work exactly? So I look at things as 3 buckets. You have a liquidity bucket, core bucket, and you have what I call a plus bucket, right? So the plus bucket is, the way it works with liquidity and core is that if you need $200,000 to live on, $200,000 goes in a liquidity bucket. This has to be completely liquid over that period of time, right? So you have to be completely available for you to be able to use on a continuous basis. So this has to be liquid. And then the rest of your money, whatever I need to put into the core money, will be used to fund your lifestyle. And then every year we replenish the liquidity bucket, replenish the liquidity bucket, and continuously do that. So between liquidity and core bucket, we put enough money in there so that's going to be used for you to maintain your lifestyle. And then we look at the plus bucket. So the plus bucket is going to be money that you're never going to use for the rest of your life. So if we figure that the plus bucket is X amount of dollars, let's say it's 500,000, then you can say to yourself, well, hey, I can maybe give more to my children, grandchildren, and or charities. Here you can convert maybe some of your money to a Roth convert. So you can do a Roth conversion here. So you have flexibility to do different things. Here, maybe you could be more aggressive. So there's flexibility you can do. So how do you actually go through and understand what your plus money is for you? The best way to do that is what I typically do is I say, okay, they have $4 million in portfolio assets. That's the John Samantha Jones example. What I did is I took $500,000 out of their portfolio assets and I reran the plan again. And I wanted to see what the probability of success was. When I did that, it showed me they're at 97%. So when I take $500,000 out and they have $3.5 million, they're still in good shape. So that's their plus money. I know that now, right? Client knows that. Now it's like, okay, well, what do we want to do with that? So one example that I'll show people is I'll look to convert that $500,000. So take 250 from wife's IRA, 250 from husband's IRA, convert it to a Roth IRA. And if we did that, what does that look like for the overall plan? So the way it looks is in the current scenario where we do no conversions at all. The client has 2.1 million. That's in 2022, which is this year. They have 2.102 million. They had 2 million. It grows to 2.102 because this is by the end of 2022 estimate. Their IRA assets in 2059, that's when they're 95 and 96 years old, is 2.794 million. The reason why you're seeing 2.794 million is because there were required minimum distributions at age 72 for both of them. So that comes out of the account, and that's why it's not as great as you would think it would be over that long period of time. So now the plus scenario is instead of starting with 2.1, we start with 1.602 million because we took $500,000 out and we put it into the Roth IRA. And we did that all this year in 2022. Fast forward till 2059, the IRA assets grow to 2.129 million. Obviously, it's less than the 2.7 because we took $500,000 out. And the Roth IRA now is 3.171 million. That means their total retirement assets now are 5.301 million versus 2.7 million. And the 3.1 million that's in the Roth, guess what? That's completely tax-free to the family. So that's your legacy transfer tool that you can use for your family. So that's the power of really understanding what your plus number is, right? That's the power of understanding what your plus number is as you do your overall plan. This is super important to understand. Other people, some people get concerned and say, hey, I love that I have plus money, but I just want to keep it for myself and if you're married, my spouse, just in case that we need it. And that's great too. But you have optionality, you have flexibility, which is the same thing as unlocking a work optional lifestyle. So to conclude, getting to the point, whether it's today or at some point you want to know where you unlock a work optional lifestyle that really does give you incredible peace of mind as we all go through life and do the things that we love to do. And we know that if we don't want to deal with the grind every day, we get out and we stop. Or we work 2 to 3 days a week in some type of consultant. I can tell you right now, there's so many people that work full time that can't stand their boss, can't stand their career, don't like the industry anymore, wish they can get out. But for whatever reason, they think they can't get out. But when you go through these types of exercises, maybe you can get out and then unlock yourself and do something part-time or whatever it may be. So once you go through everything that I just reviewed with you, the last thing I want you to think about is you have to get organized. You have to organize your estate and trust planning. You have to organize your overall tax rates. Where are you from a marginal tax rate? What type of tax carry forward losses that you have when you look at your overall taxes. So you got to make sure you're minimizing as much taxes as possible. That's number 2. Number 3, property and casualty. You have homeowners, automobile insurance. You have, maybe you sit on boards, so you have insurance for that. You have umbrella insurance. You want to make sure all the coverages are good so you're not exposed. You have long-term care issues that you may be exposed to. So you want to make sure that is all organized, whatever that plan may be. Charitable giving, if that's something that's important. And you have family governance, right? What's the dynamics of your family, your children? Who's good with money? Who's not good with money? So you got to figure all that stuff out. So our PWM 1 plan is there to organize and simplify everything, as well as put together a plan to see if you're at the point where you could unlock a work optional lifestyle. So this has really been enjoyable for me. Hopefully the same for you. I really love this stuff. And this is, stuff that I've been doing for 21 years. And when you get to the point where you sit down with people and you can help them understand where they stand, it's really an exhilarating feeling. So thank you all for attending today. I'm going to spend maybe about 10 minutes over where I wanted to be, but that's okay because I think it was helpful. So let's see what the chats look like here. In terms of liquidating a real estate portfolio, do I like 1031s? I do like 1031s. I think 1031s are really great. Depends on your tax situation. Here's how I look at it. As an example, if you have a $2 million real estate property and your cost basis is $1 million and you sell it, and let's say after taxes, you're netting $1.5 million. If you take that $2 million and do 1035 into another piece of property, the question is, what income are you going to get? Number 1. Number 2, why would you be interested in selling your real estate property? In other words, is it a headache for you? Do you just not want that headache anymore? So those are the two things you have to measure, because if the income you're getting from the new real estate investment property purchase is not as good as investing it at the $1.5 million in a portfolio as an example, or some other type of investment, then you just want to make sure you consider both options. That's really going to be important as you think about that going on. That would answer which one is better. Sometimes I found that people selling it, paying the taxes, putting it in the portfolio, get rid of the headache, is they prefer that over worrying about everything they've been dealing with the real estate property for a long period of time. In terms of leaving money behind in a Roth IRA, the benefit of a Roth IRA is that you do not have required minimum distributions. With an IRA, when you turn 72 years old, the government says that we let you put money into your retirement plan where you got a deduction, or where you got a deduction from your overall income, whether you put it into 401k or you roll into the IRA. So we let you put money in here tax-free, essentially, grew tax deferred, but now we want our money. So at the age of 72 years old, the government says that we want to start getting money from your IRA accounts. That's why they force you to take money out. And if you don't, there's a 50% penalty for not doing so. So with an IRA, that's a disadvantage. Then when you die, your children get the IRA money. And if they cash it out day one, which many have, it's fully taxable at ordinary income rates. Or they could stretch it over 5 years, or they can stretch it over 10 years, which many don't, but that's ideal. That's an IRA. With the Roth IRA, you don't have required minimum distributions. It grows tax-free. So when your children now inherit this asset, if they take the money out completely, they never pay taxes on it ever. So if you're, for example, let's say 60 years old and you convert part of your IRA to a Roth IRA, and now you're 60, now you die when you're 90 years old, for example, you're talking about multiple years of tax-free growth, and then your family inherits it and lets that grow for another 10 years. It's just a tremendous way to really build wealth over time in a very, very, very tax efficient way. All right, so we're right out of time. I'm going to stop it here. So again, thanks everybody for being on this webinar. It was great presenting. In front of you, if you'd like to schedule an appointment in the chat box, you'll be able to do so. Enjoy the rest of your day. Thank you.